Hi, my name is Josh Mahony, Chief Market Analyst at Scope Markets. I'm looking ahead here to Friday's US core PCE inflation metric. It's going to be one of the big releases of the week. I've also provided a preview for the Eurozone CPI number that's coming out on Friday as well. But certainly inflation remains the key thing to be looking out for on the economic front. And Friday's core PCE metric is the Federal Reserve's favored figure. Now, bear in mind that we have, of course, seen a year where the expectations for interest rates have been pushed and pushed and pushed. So interest rate cuts at the beginning of the year, people were thinking we were going to see 7. Where are we now? Well, maybe we'll see 1 or 2 by the end of the year. And those expectations are likely to change as we move forward. And that's going to be driving sentiment within markets. So let's get into it. First and foremost, I wanted to show you the big picture in terms of market expectations. You can see the core PCE monthly figure expected to drop down to 0.2%. That's going to be absolutely key, driving a potential move to 2.7% on the year-on-year figure. In terms of the headline PCE numbers, so the non-core ones, we're again looking for a drop down to 0.2 and a drop by 0.1 once again to 2.6%. So replicated across the board here for both normal PC and core PC. So here's the sort of wider trajectory for a number of different metrics. We can see the core PC figure is in the midst of all of this as well. But ultimately, the trajectory over the past year has been largely downwards. You can see PPI is probably the outlier to that. And we see wider swings and variations within that PPI number. But generally, we have been seeing downside move, in particular within the core figures, the core CPI, the core PCE numbers, both steadily moving towards the downside. Now, as long as that continues, it does make people think that we are at least heading in the right direction. And that does pose a potential risk if we were to see a potential uptick in terms of the core PCE number. But that's not necessarily what we're expecting this time around. But let's look from a sort of base effects perspective and see exactly how things stack up from there. So first and foremost, you can see, as I often highlight, it's the core PCE figure, which is currently 2.82. That is the most likely out of the keenly followed inflation metrics to reach that 2% target. It's closer than the core CPI, which is 3.6. It's closer than the headline CPI figure, which is 3.4%. So 2.82 is where we are with the PCE number. In terms of the month on month, well, what's dropping out this time? 0.307. So if we cast our mind back, the expectation is that we're going to see a 0.2 figure this time. And that's why we're likely to see that decline to 2.7, or that's why markets are forecasting such a move. But how things shaping up recently and beyond this coming release? Well, first and foremost, you can see that the May number looks remarkably similar in terms of the core PCE figure. So the monthly May figure looks again around 0.3. So that points towards a possibility of another sort of tick lower. But as we move forward, June, July, August, October, November, December, all of them relatively low monthly figures. And therefore, it's going to become more difficult to actually see a continuation of the disinflation pathway that is currently in play. So yes, we could get down to 2.7, and maybe next month we could get down to 2.6. But from there onwards, I think there's a good chance that we start flatlining and potentially move towards the upside for the core PCE. September is the outlier. That again looks like a figure that's just over 3%. So we can see a bit of disinflation there. And it's worth noting, you look at the figures that we have seen thus far this year, in particular that Jan figure of 0.5. We've seen some very chunky prints over the course of 2024 thus far, which points towards potential resurgence. Not a massive resurgence, not to the kind of levels that we've seen over the past couple of years, the peaks, but certainly a potential resurgence from the mid-2s up to the mid-3s, or from the mid-3s up to 4%, for say CPI. And that's not necessarily going to fill markets with too much confidence. But for the time being, we have got the potential for a continuation signal of the disinflation that we've been seeing over recent months. I wanted to provide you this. This is from the Icon platform, the outlook currently in terms of market expectations from the Federal Reserve. Essentially, markets see it as a coin toss for a September cut. beyond that, looking for November or certainly December, or certainly I say with a much greater degree of certainty. That's an 84% chance that we are below where we are at the moment. So markets are currently pricing one rate cut, potentially two as an outsider, which we've got just over 41% attributed to that by the end of the year. So really, we have seen a significant adjustment. So what's going to happen this time around, and how's that going to affect markets? Well, let's say we do see a continuation of that downtrend. Well, a move to 2.7 in the core PCE metric does provide markets with a little bit more optimism. That would give us a decline in the monthly figure and a decline in the year-on-year figure. And so despite the fact that, as I believe, once we see the June number replaced, we could start to see the core PCE number either flatline or start to move upwards. We're not in that position at the moment. So the story can remain positive in the sense that we can see further disinflation and a decline in the monthly figure, which would likely provide some gains for equity markets if we see that, despite the question marks that I have around where anyone thinks we're going to get back down to target or even close to 2% to justify a rate cut this year. I don't see it happening, quite frankly. I think we're more likely to be closer to 3% than 2% by the end of the year. So, markets now only pricing one and a bit rate cuts, potentially two. I don't think that's likely, quite frankly, unless they're going to cut rates with inflation particularly elevated. And that's not necessarily something I think will happen personally. In terms of some markets to watch out for, let me just go full screen on this. First and foremost, this is the Dow Jones Industrial Average. This is the market that at the moment, if you're looking for a market to potentially look for downside, this has been the underperformer against the likes of the NASDAQ and the S&P 500, in part because it doesn't have NVIDIA in it. It has a lower count of those big tech names. You still have some of the really big names like of Apple and the like within the Dow, but we don't have all of them in there. And therefore, when you see the likes of the NVIDIA earnings coming out and propping up the market, we don't have that same level of support for the Dow. So we're seeing a pullback for the Dow. I think, is this a topping pattern? Well, that would need a breakthrough support of 37611. I don't necessarily think that's the case. I don't think we're on the cusp of a massive collapse for this market. And therefore, in my opinion, we're looking at a retracement. But that doesn't necessarily mean that the selling is all over. We could still see further downside coming into play. I'm just seeing where we're tallying up. So we've gone past the 38.2. The next support level comes at the 50 mark, which is at 38845. Below that, we've got the 61.8, which is 38554, and then 38194, which is a 76.4 Fibonacci support level. Ultimately, I think it just makes sense to follow this on an intraday basis. So essentially, if for me, I see this as a retracement. I don't know where we're going to retrace into, but I think over the near term, you can either look for short-term counter-trend moves with the fact that we've broken through support here could provide us with another leg low, especially given the fact that we've seen a shallow retracement coming into play here. Let's just get the shallow retracement tool so you can see here. Very shallow retracement there, 23.6, pretty much on the nose there, and now selling off. So those are the kind of entries that I like to take on the breakthrough on this occasion, swing low. But of course, if it was a bullish trend, then you'd be looking for example, entries at that breakout through resistance because of the shallow nature of that retracement, and then looking to replicate that move upwards for one time, two times, depending on how you trade these things. Towards the downside now, we've broken through support. So that points towards the possibility of near-term downside to continue this bearish trajectory. But like I said, I don't think that this is a long-lasting sell-off. I don't think we're going to break through this 37611. And so in my mind, I think there's a good possibility that even if you're looking at shorts, maybe people will look at this as an opportunity to take advantage of near-term downside moves. It's difficult when you're going counter trend because ultimately you're betting against the wider move, and the wider move is very much a bullish one. So, I'd keep an eye out for that 1 hour chart. If we see a break up through the price swing high, which is currently at that 23.6, which is 39227, if we break up through that swing high, then that starts to tell me a story that the selling pressure is done and that the bulls might come back into play. So keep an eye out for the Dow in particular. And another one to keep an eye out for is the dollar index. Certainly, if we come out with these numbers and we see disinflation across both the monthly and the yearly figure, it's not necessarily going to spark a massive risk-off move and see a massive surge for the US dollar. If we were to see the numbers come in higher than expected, then yeah, we could find support for the dollar index. But nonetheless, if you look at the trend over the course of 2024 thus far, it has been bullish. And the pullback recently came into trendline support, which essentially confirmed it with the third touch of that level. We regained ground, but we ultimately found ourselves moving into I would say it's a mid-sized retracement. It's probably a 50% move here. No, it's a 61.8. So perfectly on a 61.8, then we roll over. So, if you're looking on an hourly time frame, you can probably say, hey, we're in a downtrend. But then you look at further out and you say, well, this sell-off that we're currently seeing, forms a wider bullish trend. And that bullish trend comes back into play now that we've come into trendline support. So does trendline support hold? If not, do we break through that 104.065 to provide further downside and a continuation of this bearish trend? If that's happening, you'll be looking at the possibility of a wider pullback. And so you'll be looking at these fib levels, 103.952, 103.343. Those are the sort of deeper 61.8 to 76.4 fib levels worth noting. But at the moment, we're looking at this trend line support to potentially hold up. I think, the difficulty here is that for this to hold up, we might need some risk-off sentiment to come back into play. I don't necessarily think that we're going to see it in terms of the core PCE number, because it looks likely we either see a decline or maybe flatlining. And the sort of warning signs are probably going to come a couple months down the line when we start to see it move higher and people realize that we're not going to get to 2% anytime soon. So that's not happening at the moment. So, that doesn't necessarily, for me, signal that we're going to see a big risk-off move here. But certainly from a technical perspective, this key trend line will be absolutely key. Do we break through it, or do we ultimately reverse through the first swing high, which on this occasion is 104.529? If we break through that level, then the bulls can come back into play following this decline into trendline support. So a couple of key markets to be watching out for: core PCE number, the favored metric from the Federal Reserve, coming out on Friday. Markets are expecting declines on both monthly and the year-on-year figures. But even if we do see people acting in a positive manner and believing that we're on a lovely downward trajectory towards 2%, as I've outlined here, that's very unlikely. Beyond this reading, we got one more reading where it's relatively favorable from a base effects perspective. And then from there on in, there's a good chance that we start flatlining or moving towards the upside, and people realize this is going to be a little bit more difficult than we had originally anticipated. That's where we could possibly see some risk-off play moves coming into play. But for the time being, dollar index back at that key support level, the Dow rolling over with no parachute provided by NVIDIA that we're seeing for the likes of the NASDAQ and the S&P 500. So as things stand, we are seeing some concerns within the markets as markets continue to price less and less rate cuts for 2024. Will we get to the point where we essentially price in zero rate cuts? I think there's a very, very strong possibility that that's what happens down the line. I hope this has been useful. Make sure to follow and like this video and this channel. We'll continue to provide you with key insights for different events and week aheads and earnings and you name it. So yeah, thanks for tuning in and check us out next time. Remember, I've also provided a similar kind of video for the Eurozone numbers, different kind of dynamic on that side. But again, inflation remains an issue given the significant figures that we've seen certainly at the beginning of 2024 thus far.